the Miller Income Fund looks to own mispriced yield for the long term. We, the Miller family, is the largest investors in the fund by a long shot. Almost a third of the portfolio right now is in stocks with market caps under $10 billion. Again, the ability to be opportunistic really differentiates this fund. And, one of the implications of capital having a cost again is that securities which produce excess amounts of it get more valuable relative to their valuations over the past decade when the world was awash in capital and it didn't mean anything. Right now, our biggest position is AT&T, which we think is worth meaningfully more than where it trades today, low to mid 20s, call it, against a current price of $16. It's a high 6% dividend yield against a 14% free cash flow yield. Why is that valuation compelling? Because it's the same valuation where AT&T traded in the financial crisis. Right now, there's no crisis. AT&T is cutting back on their CapEx and free cash flow is growing. They're using it to pay down debt and buy back stock on top of the dividend. So I think it's a really good example of why we're mainly still in stocks. About 20% is in bonds and concentrated positions where we've done a lot of research and believe we have a differentiated view on what the credit is worth. But again, we have the opportunity to be very opportunistic in the strategy. We're the largest investors in it, and we're incredibly optimistic about what we could do over the long term. The basic framework here is we look at the dividend yield, which right now is a very clean income-only yield on the fund. We're not paying any return to capital. And we think we can get capital appreciation on top of that dividend yield if we can get our position security selections right. One other position which we've mentioned in the past and is one of our biggest positions is Stellantis. Stellantis' valuation today is incredibly attractive. It has an incredibly attractive chart for those that follow that. It has an incredibly attractive management team, which owns approximately 14% of the company. It has no debt, an enormous cash pile, and a high single-digit dividend yield. Kicks off a ton of free cash flow at in the current environment. Obviously, that can change, but the management's buying back stock with that free cash flow and investing in the business. And so these at 1.9 times enterprise value to EBIT and no debt, and most likely going to be selling more cars in 10 years than they do today. We think the long-term risk there is very, very low. So we still think there's meaningful upside.